All right, CP Rail is the latest industrial company to lower their forecasted growth. Is there more pain to come for CP as well as the rest of the sector? Joining us now is Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management, standing by at the TSX Broadcast Center in downtown Toronto. Diana, good to be with you today. Thank you.
Thanks for having me, Catherine. Nice to see you.
So some of the analyst notes I read about CP said that they were expecting a bit of a miss, but it looks a little bit more concerning than that in terms of the volumes and the slowdown and reducing guidance. What's your take?
I think that the market is disappointed because money has flowed into the cyclical trade, and the rails are that cyclicality where you're putting your money where you're hoping that the economy is doing better. That's when rails do better. And so the expectations were that the decline in volumes, the rate of decline in volumes was going to subside a bit. The stock is down about 5%, so clearly there's disappointment, but there is also some rotation out of everything into energy today. So that's taking some funds away. From what I've seen, we give the industry, the rail, that is, industry, another benefit of the doubt. As you know, they're starting to have a little bit of pricing power. And if you believe that the economy is bottomed out and slightly growing, and if you believe in the cyclical trade, or if you think that you should now stop being fully defensive and maybe have some cyclicals in your portfolio, because we might be at that crossroads, I think the rails could be one position. From our perspective, we have CNR rather than CP we own in our portfolios. We don't want both. It's the same type of metrics that drive them, but CNR has lower exposure to utility coal, also has a lower operating ratio. So when we had to pick one, we picked that one. And CNR is down about 25 beeps, I think, or 0.5% when I left, in sympathy. So we'll see what the report is there. But we're giving it another benefit of the doubt.
But Diana, when you take a look at not only CP, but some of these other industrial companies, there's been quite a few disappointments, much more so than the market was anticipating. More so maybe in those U.S. Industrial companies, because we're just starting to hear about the Canadian ones. But doesn't that put a little bit of a pause for concern in your investments to move into cyclicals?
So there's different cyclicals, and the expectations on the industrials have been so high. So for example, if you look, Honeywell reported, I think, is one that stands in my mind, that reported in the U.S. that missed and got punished. Really, there was a conference the week before, and management spoke and did not say that there was anything amiss relative to expectations, and so the earnings were okay, but the expectations were higher than what they reported, and disappointment with the fact that management did not give heads up a week before punished the stock. Rates, from our perspective, are no longer going down. I think that central banks are, or at least it looks like it now, the rhetoric, the spoken word is trying to build in a little bit of inflation expectations.
Yeah.
Not that there is inflation, but that rates are going to at least not go down. A quarter point in December is a non-event, really. It won't make a difference. It's the trend.
All right.
So we think that we still barbell and actually move into the financials and technology.
All right.
Those are exhibiting relative strength.
All right, Diana, we have to leave it there. Thank you very much.
No problem.